Thank you, everyone, for joining us today on our panel on disruptive technology and its effect on portfolios. I'm pleased to welcome all our panelists. We'll start with Nat Barker, who's a managing director and co-head of investment-grade corporate credit at Barings. To my right is Chris Bartel, who is global head of fixed income research at Fidelity, with a background in both equities and fixed income. Bill Brady, to my left, based in San Francisco and in New York, right? Bi-coastal. Yep. So Bill Brady is managing director and vice chairman and chairman of the global tech group at Jefferies. And Stephanie von Friedberg, Vice President of Corporate Strategy and Resources at International Finance Corp, based in Washington. You'll be our voice on emerging markets. And we have with us as well Alex Griffiths, Managing Director, Group Credit Officer of Global Corporates at Fitch Ratings. He is based in London. We're going to talk about disruptive technologies and their potential impact on portfolios, how to hedge or capture some of these trends, which are many, many years in the making. So timing is critical here because it might take a long time for these trends to play out, but once they do, it'll be very quick. So with that in mind, Alex, why don't we start with you, because you authored a report on batteries. And let's get this conversation started on energy and how emerging battery technologies is changing the way we look at oil. How far along are we here?
So the genesis of the report was, I started off my career in analysis as a media analyst, and I'd seen the directories businesses, the music businesses be completely revolutionized and chopped up by changes in technology. So I was running oil and gas for the last 4 years before taking this job and wondering, could the same thing happen to the oil companies? And there's really two questions. One, will electric cars and batteries be the death of oil? And two, how quickly will that happen? So one is probably, it looks like as good a candidate as anything to actually be the thing that really has a bad effect on oil. It'll bring forward that point of peak oil demand. And yeah, we'll be using oil for a very, very long time, but once the market starts shrinking, not growing, it becomes a far less pleasant place to be. How long does that take, though? And that's a really good question. Cars, unlike mobile phones, last a very long time. So a car is used for about 20 years. Mm-hmm. Mobile phones are 2 or 3. So the sheer pace of changeover is a lot slower, and you take a long, long time to actually get to a place where there are more electric cars than internal combustion cars. I mean, just to give you some numbers around that, there are about 1.2 billion cars on the road today. If we look at the picture in 2035, we're probably talking about 2 billion because people expect China, they expect India to grow. So the car base is growing. Electric cars make up less than 1% of total sales today. So if you increase that by 30% a year, compound average growth rate, over the next 18 years, every car sold in 2035 will be electric. But having done that, you only get to about a quarter of the car pool being electric. And in fact, by that point, there are more internal combustion engine cars than electric than there were now. So there's 1.5 billion versus 1.2 billion. So it is a very, very slow burn.
It's a slow burn. So what does that mean as someone who looks at the equities of these companies, Chris? Do you continue to bet on Tesla, but in small amounts, and continue to put your money in the GMs and the Fords of the world?
So I think that Tesla has been the absolute forerunner. In fact, I think if you rewind about 4 years ago, 2014, there was a book by an author named Tony Sabo, which talked about energy disruption. And at the time, it was really provocative because none of us had seen a car that really we could envision ourselves owning and using as a replacement to a traditional combustion engine car. Fast forward to today, and everyone who's had a Model S experience is sold on it, or I would say almost all, and all of a sudden it's become conventional wisdom. So I think Tesla has been the place to play. Clearly, BMW, all the big German automakers, the US automakers, everyone is investing and catching up. The question is, can Tesla stay ahead of them? They have the financing to do it. The stock continues to go up, and that's a self-fulfilling prophecy. It's cheaper and cheaper for them to raise more money, but it's going to get more competitive. There's no doubt about it. That being said, I think there are a lot of derivatives as plays as well. I mean, Mobileye was a great play with the autonomous vehicle technology. Mm-hmm. They got bought by Intel. So you're going to see a lot more, I think, private companies coming public in that area, and derivative plays as well.
Now, what about you from the fixed income perspective?
Yeah, I mean, I think the important thing to think about on the fixed income side is that I don't really have the upside, like Chris does for the equities, and Tesla's not in my space. As for instance, they're not a They are not an investment grade bond issuer. And so for me, looking out in the distance, it's kind of all about where do I see the long-term trends and what's going to make sure that I get paid back and doesn't default for me. So the things that I'm kind of worried about is less about, I've got upside in Tesla or Mobileye where I can't invest in, but more sort of but what are the second derivatives and what are the plays there, or even the first derivatives? So how do Ford and GM do, which are sort of mid-BBB rated credits that are out there? What is technology? Does Apple buy Ford? I mean, I'll make it up. I mean, someone's going to have to make these cars. Foxconn makes the phones, and kind of how does that sort of play out? And do they survive, or do they ultimately, do they default? And then thinking about also kind of other industries as well. So for me, I'm kind of all about making sure I'm watching for the losses on the other side. And so if you're a personal auto insurer and that's the focus of your business and you haven't really paid attention to it, what does that mean? We don't own cars personally. They're in a fleet that's out there if they're autonomous. Maybe we have this issue where they don't necessarily crash as much, et cetera, et cetera. So I think that's sort of the places that I'm kind of thinking about is where do I kind of get burnt on it, and how does it sort out on the downside?
So you're looking at it from a more defensive point of view.
Always a defensive play. I mean, they
Always
describe my business as picking up nickels in front of a steamroller, right? And so I don't want to get hit by the steamroller. Keep picking up the nickels.
Chris is allowed to partake in the growth.
Both, yeah. We avoid the autos on the credit side, definitely.
How about you, Bill?
So I'm the opposite of everybody else in the panel. So I'm the VC/investment banker who looks at everything like the sun is shining all day long. And particularly in autonomous cars, the sun is shining in Israel, and that's where we go a lot these days. So we're going back to Israel next week. Mobileye was one example of something that got captured out of Israel. The technology that the Israelis are doing across the board in autonomous technology is fantastic, and it's coming back to Silicon Valley. I've been in Silicon Valley for 30 years, and I haven't seen the coalescence of technology that we have today. So in the electric cars, you have battery technology, camera technology, radar technology, mapping technology, connectivity, artificial intelligence. And so all those used to be verticals for us, and they're all becoming together, right? Because you're building a vehicle, you're building a business out of that. And even though Tesla has sold a fraction of the cars of General Motors, both companies still right now have $50 billion market caps. So you have to choose what you're going to buy. You're going to buy Tesla at $50 billion, or you're going to buy GM at $50 billion. The former CEO of GM is on the board of Jefferies, so I've spent a lot of time with him. And he thinks there's going to be more change in automobiles, especially electric automobiles, in the next 5 years than have been innovations in cars in the last 50 years. So they're putting all their money there, and he's coming out to his son actually now lives in San Francisco and is working for a company that we're taking public, and he spends about half his time in San Francisco now going around the valley to talk to companies about what they can do in autonomous cars. And one of the things he's told me was he thinks the asset utilization of cars over the next 20 years is going to go from 4% to 50% as they become utilities. And so you're not going to go to a car dealer and buy a car. You're going to go to a car dealer and they're going to lend you that car for the week or the month or the day or whatever it is. So he thinks it's that a lot of the car industries, delivering cars to you is going to be through a service, and they have to because other independent people are going to start those services, and they're going to have a lot of capital because Silicon Valley has seen what Tesla can do and seen what some of these, what Uber and Lyft have done in the valley, and. They also claim, and he believes in this also, that 95% reduction in auto accidents and related deaths if we go to autonomous cars. Now, a lot of us in this room would say, that's crazy because probably the first 5 or 10 years of autonomous cars are going to be some pretty strange accidents. And we'll have to get through that, but that is some of the things we're hearing right from the top of GM. And we also did a lot of financing for Elon at Tesla. And and obviously he just launched another rocket yesterday. So you're never going to bet against him on anything. I worked with him way back in the mid 90s when he was doing X.com, which ultimately became PayPal when he merged with the PayPal guys. So you never want to bet against Elon Musk, especially when his head's in the game.
Alex?
Just going back on Bill's point there about talking to GM, talking to other car companies. They're the gatekeepers at the moment. They're the guys actually building the kit. So to an extent, they're defining the timelines. And interesting, VW is now saying that something like 25% of its cars by the mid-2020s are going to be electric. And that's a target. You talk to all of them. They talk about battery-powered cars being fully compatible, fully interchangeable with internal combustion cars sometime in the next 10 years, if not sooner. The numbers keep getting pulled back. So there is going to be there's going to be no roadblock to changing from internal combustion to electric going forward. Yep. I guess the second point I'd like to pick up on is the one about car ownership, because I guess it's very easy. I was listening to somebody a couple of days ago talking about pods, anonymous, this horrible little white pod thing, which can you type into your phone, it comes, it picks you up, it takes you where you want to go. It's self-driving, it's wonderful. But why do we own cars? Why do we spend so much money on cars? It's because they're probably one of the biggest status symbols you can have, right? There are a lot of different reasons for owning cars. There's autonomy. You go to emerging markets, people have cars, people drive cars because they're a symbol of freedom and what I can do, not because it's some pod and it gets me from A to B. So I think there'll be some cannibalization, but there's probably going to be something a lot more complicated that will happen that we can't picture yet.
Yep.
Well, Stephanie, talk a little bit about the view on autonomous vehicles in emerging markets where people have enough money now to buy cars and they want to feel like they're the master of the road when they're driving around.
So there aren't that many people that can afford to buy four wheels in most of the markets in which we invest, but batteries are important. And I wanted to come back to this idea about batteries because we've been thinking about batteries really differently, and we've been thinking about distributed generation. So there's about $1.5 trillion infrastructure gap every single year in emerging markets. So a lot of that's power. How do you get power? Do you build the generation? Do you build the distribution? Do you build the grid? Or do you go to a completely decentralized model where a community owns the generation, they have the adequate battery storage, and they actually finance the generation themselves? You're seeing a lot of that now in Sweden and some of the Nordic countries, and we're picking it up and beginning to use it in emerging markets. So batteries have a really important role to play there. They have an important role to play in prepaid devices that allow you to light your house, electrify your house, give yourself Wi-Fi, do all sorts of really interesting things with a prepaid chip. So batteries are important in emerging markets, but in a really different way.
Right, absolutely.
That completely echoes an experience of looking at Nigeria quite closely over the last few years.
Yeah.
They've spent huge amounts of money trying to electrify, trying to bring power to the population, and the problem is the institutions just aren't enough to keep it all working. So getting distributed generation, there are problems. It's not perfect. You look in a developed market, if you've just got solar panels and a battery, if it's not sunny for a few days, you've got a problem.
Yeah.
But if you've got nothing to start off with, then you're flying.
But we talked a little bit, and we talked about this before. So we have big equity positions all over the world. And one of the things I worry about from a technology perspective is which of our equity plays are going to go under because of technology. So we've lost money, a lot of money in early solar deals because the cost has come down so dramatically. When we first started doing solar in Africa, it was probably 20 cents. Now it's down to 4 or 5 as long as we get the auctions running properly. So between the equipment and the auctions, the cost curves are coming down so radically. So, even in emerging markets, you need to be careful with what technology you're investing in.
Well, and the service providers that have gone public in the last 2 or 3 years, the stocks have just been obliterated as well in the U.S.
Yeah.
And the one thing, we sort of haven't really touched upon this is this idea of what the cost of the batteries are. It certainly is fairly prohibitive to put in batteries right now, be they distributed or out, if you want to centralize them on the grid for your utilities. And I think there's sort of a magic number, about $100 per kilowatt hour. We're not there. I don't know what Musk currently says. With his gigafactory, he's probably pretty close. I think he also said that we were going to nap in our car 2 years ago, and now it's 2 years from now, and it's 2 years from tomorrow. So, it still is cost prohibitive, such that you don't see it out in force out in the utilities that most of you who live in the United States know and kind of use. So if you think about someone like Nextera, who's a heavy early adopter into that space, into the solar space, again, they're experimenting. They're not kind of deep into it. So we need to kind of ultimately change the technology, or I think the key will be if we have some sort of fracking type revolution in terms of what the style of the battery is, or what the ultimately that's out there. There are other kinds of batteries. I'm not a technologist, so I'm not going to go into these vanadium flows and these other ones. But you're going to need something, and it needs to be low cost. Some need to be small for cars, and some they can be as big as you want for a utility. But they have to be incredibly robust. And we also need to bear in mind that we also demand power on the spot here, and the utility space, much of it is regulated, so they're going to be very slow adopters of it. It's going to have to be incredibly proven technologies, and if the light goes down in this room, we're not going to put up with it. So that's sort of a key when you're thinking about that kind of lifetime, lifespan as to what it's going to do. Again, I'm always like, well, where's the negative in this? And I can find, any glass that's out there that's an eighth full, even though it looks full. The place that I would, though, in terms of thinking about the battery space and what it's going to do, is to me that's another reason why the merchant power market that's out there sort of looks a little spooky. And it looks spooky because now it takes solar, and then if you can do the batteries, and you've got wind as well, you can store it, and so there are defined business models that are based on this idea of dealing with peak power, and that business model gets completely wiped away potentially if you add that in. And then current policy as well, the other additional factor, because it's always a matrix, is clean coal, right? And so coal is just adding for another inexpensive potential way to go deal with this sort of peakers in the merchant market. So I think regulated will be slow, and it's a long way to say it, but again, it's sort of looking to, well, what's my downside? I think to me that's why, like a place like merchant power really spooks me, and even more so with this technology.
All right, so now it's looking at what's my downside. Chris, what about where's the upside? What kinds of companies do you then go for? Do you look for a company that focuses specifically on battery power? Do you look for an energy company, one of those big multinational, formerly Exxon, that's branching off into different kinds of energy?
Well, I think energy in particular, you do have to be really careful, and I agree with Nat. And on the credit side, you're not getting paid to take a lot of risk. The spreads are really tight. The spreads are tight across the entire corporate credit spectrum right now. But why buy, especially a long-dated piece of debt that's tied to a company that is at risk over the next 7-10 years and not get paid for it? So I think I would be in his camp to just avoid that space. I think the opportunities, they're pretty concentrated right now, and a lot of them are still on the private side. And so I think it limits what a public investor is willing to do, because the problem with anything in the automotive space is you're at an 18 million, give or take, SAR right now. That's a really high number. A lot of people have said this is the cyclical peak. And so if you're buying any traditional auto company that you think is going to start to be a competitor to a Tesla, you're basically making a bet that we're not going to see the cycle roll over. They're really benefiting right now from strong demand from SUVs. Is that sustainable? And so I don't think that there are a lot of obvious plays in that auto space other than Tesla, which is at the same market cap as GM. So you're paying a lot for it.
Yeah, they actually crossed GM.
Yeah.
And I guess I'll stay with the glass full and maybe rolling over. And that is that if you don't have to invest directly in the car company that creates these cars. You can invest in the software, you can invest in the hardware, you can invest in the integrated circuits, you can invest in the fuel efficiency, the safety, the lightweight materials, so that if there's 10 racing down the path, you can have investments in all of them. And if one is Tesla, then you make a great return. So all this drives all of our categories: software, integrated circuits, hardware, and navigation that we have, and it's going to benefit the whole category. I don't think there's going to be one big winner or loser. Obviously, Elon's way out front right now, but I think overall you're going to want to bet on the things that are inside these cars, just like you bet on when HP and when Cisco had a box that had 16 protocols that it supported back in the early 90s, and no one else supported one. All you had to do was buy what was in that box. You didn't have to buy the box, and that's what's happening today with these cars. Is everyone's trying to build these cars, and they're putting the same type of components and software in them. Buy the components and software, and that's where you get the benefit. Because it's very hard to choose. When we took Cisco public, there was a company called Wellfleet, and there were several other companies, Cabletron and Synoptics, and all these companies. And all you had to do was choose the group, and then Cisco became Cisco during the 90s, which was one of the greatest runs we've ever seen.
I would say the only problem there is you've just seen this massive move in the entire SOX, the semiconductor index, even the semi-cap equipment companies, they've all benefited from this, the Amphenol's of the world. So they're all sitting at multi-year highs, so there's a lot of good news in there. And I agree, the content's going to go through the roof. But it's like what I was talking about with the auto space. You're paying for a big cycle for a lot of the companies with the best exposure.
So what I think is really interesting about this, we spend a lot of time looking at supply chains, right? Because investing in different emerging markets allows you to connect to supply chains. I actually think that robotics and aging is going to fundamentally change the way that supply chains function. So if I were an investor looking at the automotive space today, I'd be looking at who's going to nearshore, who's going to come back into the United States, because we're an aging population. Robotics are going to work. We're going to grow our GDP. We're going to start leveling the GDP between emerging markets and the developed market as robotics come and drive jobs, robotic jobs back on shore. And it's going to be driven by supply chains, because it's going to be far easier to do it in the US than to do it in China or to do it in India or to do it anywhere else, where you're trying to piece this all together.
Well, how does it work in the emerging markets?
And blockchain will help.
How would it work in the emerging markets?
So I think that the emerging markets are going to suffer. I think that a lot of the growth you saw in China that was coming over here is going to go away.
But does that get replaced by growth in China?
I don't think so. Not immediately.
Okay, I mean, one of my favorite stats is there's 0.8 cars per person in the US. In China, it's a tenth of that. So you've potentially got a huge amount of growth in China. So do you actually want to be more insular and focused here where the market is stagnant, or somewhere where it's growing really rapidly?
But what I'm implying is I'm not sure that the market here is going to be quite as stagnant. I think GDP growth is going to grow faster here as robotics bring things back on shore, right? Because we don't have the young population. The young population sits in China and Africa and somewhere in the Middle East, right? They're the ones that have to have jobs we don't. So robotics will make us more productive.
Will that be captured in the data? That's a separate question as well. I want to switch over to talk about machine learning and artificial intelligence. When we talk about machine learning and its recent rise, what industries are most affected by it? Nat?
Well, I think there's a whole host of different industries that will ultimately be affected by machine learning. I'll just make it a bit personal. So not only I'm a portfolio manager, but I also have the portfolio management team for my sector. I have the analysts and I have the traders, and you have heard quite a bit around fintech, but it is really getting quite a bit of momentum. And so the technology side on machine learning, it's not just low-level jobs. It is ultimately.
It's not the data input guys.
Well, yeah, but even that stuff's getting all cleaned up, and that's sort of the nature of where big data is going from. It's no longer data cleaning and organizing and storing. I mean, it's now actually tapping out into these file-based systems. But I think you end up rising it up so that it's actually analysts that I have on staff that are looking at. That are looking at individual credits, and the ability now. I mean, there's a company out there we've met with to talk to them that they can take a 10K and it will read the 10K and it will summarize it in a very similar fashion to what I know that my analysts do. I'm sure Chris' analysts probably do, and it's incredibly rote what they do. But there's an element of doing that, getting it aside. It has to be in the system. I look at it as a portfolio manager. I want it to get done. And then kind of high grading that experience, what you're looking for them to do, so that they're looking for relative value. At the end of the day, though, do I need to have 14 analysts that follow just this sector, this asset class, or is it a way to then go from 14 to 2, or maybe even less so? And then I think the other place for me thinking about it, and this is in finance, and it's just sort of very personal, is if you look at the corporate bond market in particular, only 20% or so of the trades are done electronically. The rest of the 80% are done what we refer to as high touch. They're either on the phone, you've got a trader on the phone, or he's doing with IB messages on the beloved Bloomberg.
Yes.
There's my pitch for Bloomberg.
Shameless plug, thank you.
Yeah, that's right, shameless plug. But you think about the change that's out there, and there are firms that have credit algos now that can instantly price up bonds. Give them 1,000 CUSIPs and they'll have a price. That previously that was a 3-day affair if you gave them 1,000 CUSIPs to really come back with firm prices on all of them. And then what does that do for that trader's time and kind of freeing them up? So I'll just talk about that because it's personal, because it's not only running the business, but then it's also looking at 28%, 30% of the whole index of all the available names are also finance companies. And so they ought to be doing that. And if they're not retaining customers, they're not reducing costs, they're not dealing with fee pressure you see across the space and all sorts of a host of the other things. So who's performing the best, and are they the best possible that you can kind of invest in?
At Fidelity, we have several million clients ourselves as investors, and the amount of analysis that our distribution side of the business, I'm on the production side, the investment decision-making side, but on the distribution side, just analyzing clients' behavior and understanding when someone is starting to near retirement, how is their investing changing? How are their preferences? What kind of questions are they asking when they call into our phone banks? You can literally take millions of these calls and start to process them and start to anticipate and provide products that are better suited, or offer the phone rep better counseling in terms of here's how you handle each of these situations. So I think to Net's point, I mean, all of these financial firms have just a wealth of data at their fingertips, but you got to be able to process
this is this idea of radical personalization, right? Is before that person who'd pick up the phone when you're on Fidelity, and I'm a Fidelity customer, they would call and they might just lock you into sort of something very simple. Now they'll ask you a bank of questions, or you'll just do it all online. And that is frankly what millennials want. They may not even want to talk to anyone. So they'll do the whole thing online. This is what my personality is. This is what I believe my risk factors are. And then through big data and AI, it will actually put them in a much more, in the same type of quality portfolio that you probably would have had, I don't know what it is, $1 million minimum to get into like the high net worth, kind of space in terms of that level of high touch. And you're now doing it with that. And so you can kind of think about all the bodies that it's displacing and sort of the quality of the product that you're getting.
And there's minimum friction as well. Bill, you are our tour guide for the millennials.
I am. And I just saw Joe Chen, one of the innovators of marketplaces, in the back of the room. So there's 70 countries around the world that have marketplace lenders. And there's 28 fintech unicorns being private companies who have a greater valuation than $1 billion. There's 28 of those. And Venmo processed 1 billion peer-to-peer payments in February alone. So when you get to the millennials, which is what I always look at when I'm analyzing what companies to work with, 40% of millennials would consider doing banking with Google alone and forget everybody else. 71% of millennials would rather go to the dentist than listen to what banks are telling them. 63% of millennials don't have a credit card. So while everyone's looking at credit scores and credit cards, companies like Lending Club and Funding Circle are growing dramatically. And on-demand insurance, automated investing, like a company like Betterment, Earnest, and LendUp, which are smaller ventures in the area, are all coming in very aggressively. And since 2011, fintech companies have raised over $34 billion across 3,000 deals. So it's a wave that's coming. We've seen these waves over the last 30 years. They always come, everyone always doubts them, and usually, in my experience, they come over and either get us or you're riding if you're ready for it. So it's the biggest wave we've seen outside of autonomous cars, and a couple other things we'll talk about in a little bit.
Stephanie, what do you see?
So the big fintech in emerging markets is M-Pesa, which nobody's been able to replicate. Right. So we'll come back to that one. This radical personalization from an emerging markets perspective is really interesting because what it does is provide opportunity for SMEs. And if you attach blockchain and you think about what's going to happen with Amazon and Alibaba and some of these guys on steroids, you're going to completely disintermediate the supply chains that exist, and the SMEs are going to be able to serve you because I'm going to be able to say, this is the apple that I want from Washington State, and it's going to come to me, right? And Alibaba already does that. They actually take apples from Washington and take them to China. So the big question for us is, okay, how do we actually get the credit to the SMEs? So we've actually started to use big data to create credit bureaus. So we started in Jamaica. We said, okay, we have an existing credit bureau. Let's see what their mobile data will tell us, and can we correlate these two things and be able to create someone's credit profile with absolutely no credit. And believe it or not, using mobile data alone, you can get very, very accurate guesses about a person's credit.
And very timely, too.
Very timely. So now in Africa, we're using these different algorithms to actually see what we can do to create credit bureaus so that the banks that we on-lend to can do SME lending.
Sometimes you even have governments that do things that will drive the need for technology. And I'm thinking of India with Prime Minister Modi at the end of the last year basically did away with all small currency bills and just an entire nationwide ban. Something just incredible to imagine that they actually did it. And they did it. It was disruptive. But you can imagine the demand for electronic payment services and just, a variety of them. They have to be ubiquitous. They have to be fail-safe because otherwise the entire economy will grind to a halt. And I don't know that other countries are going to look at that and say, hey, we want to try that too. But once they go through it, it will improve their ability. Money laundering will be much more difficult, theft, all those sorts of things. And so it's definitely the direction that we're going, although it's going to be slow unless you have an autocrat that basically says this is what's going to happen.
Yeah, the argument for the big data as well is also one of the arguments out there as to why Silicon Valley wins this autonomous car idea as well, is that just like we all sign up for Facebook and we think it's free, it's obviously not free. We're cutting a deal with someone.
We're giving up our soul.
We're giving up our soul,
Yeah.
but because they want the data, right? So it's all that data exhaust, and then that ultimately leads to this radical personalization, which we get these pop-ups for things that we're supposed to buy. That's the idea. Same with the autonomous car is that it frees up this time. My hour commute, I now sit in the car, I absorb data, I fiddle around with the thing, I read news, I do whatever I want. But the point is that I'm creating data. I have no ability like Waze to turn off never to follow me all the rest of the time. It's now all the time. And so they have all that data they got for free, and they may completely subsidize the automobile. And it's sort of the radical extension of it. But it is one argument as to why it may significantly change the cost structure of what the automobile, because I'm making a Facebook deal, if you will, with another amount of free time that I'm riding around in this vehicle.
So Google estimates that Americans spend 300 million hours a year behind the wheel of a car. So ask yourself, why does Google want to have an autonomous car? It's not because they want to build an autonomous car. It's because they want your data and they want your eyeballs.
Yeah.
Right? So they're way ahead. And I would put my money on Silicon Valley over any of the automakers.
Alex, is there going to be a big pushback against all this data that every company is collecting on us? I mean, right now we're giving everything away to Facebook for free, but at some point is someone going to say, you know what, that's enough, I'm not going to do that anymore, and will that catch on?
I think there is certainly the risk of all these things. There's going to be bumps, right? So the first autonomous cars kill people. They drive the wrong way down a freeway, whatever.
Yep.
So suddenly that becomes a bad idea. One of the tech companies goes bad in some way. There's something really awful happens. People pull back again. Yeah, we've seen over the last year the ability of people to actually start to say, no, hang on, we don't want this anymore. We want something else. So I think there will definitely be breaks and bumps in the road, and we may well end up with something with a lot more regulation than we currently have. I was listening to the tech panel earlier, and they were saying we know this is a problem. We should start doing something about it ourselves. No one is kind of there or doing anything yet, but I think that there is, again, it's this danger of just extrapolating into the future everything that could be. There will be something. There will be some regulation. Are all taxi drivers going to go away? Are all truck drivers going to go away? Yeah. They could do it. Technology can do it, no problem. But is that something we want as a society? And that's a more interesting question.
Bill, when you look at what's different this time, because in the past you laugh.
15 years ago?
Well, yeah, I mean, we go through these cycles, right,
period.
where artificial intelligence has a high, machine learning is the rage, and then we kind of go into the spell where people are critical of it or suspicious of it. Now we seem to be at a high again. What's different this time? How are we going to push the ball
The
off?
difference is that we had a really bumpy dirt road back then, and we do have, the word back then used to be the information superhighway, and it was hardly the information superhighway if you went online and tried to do anything back in 99,
It was a
2000.
country road.
And the development since then, in the back end, first, between 2002 and 2008 or so, you had back end deployment of a bunch of optical technology companies and all this infrastructure. So just assume that you had everybody in America going out and paving roads for 8 years. And that's what was happening. And then, lo and behold, you get this device. All right, whoops. Which takes my mic away. And so if you have a pretty powerful computer in your pocket, and now in my chair, and you've got a road which is smooth and has a lot of lanes and doesn't have a speed limit, that's why things are growing the way they're growing. And also you have innovators like Elon, like Jeff Bezos, and a lot of others who just have this passion to create things that most humans don't think of. And it's inspiring to be around them, inspiring to be in the valley with them.
Thinking about this market versus NASDAQ, and I was a tech analyst in '99 and lived through that implosion. Right now, the 5 biggest stocks in the S&P 500 are Google, Facebook, Amazon, Microsoft, and
Netflix?
No, not Netflix.
Alibaba?
yeah, not in the S&P 500. But anyway, they're basically close to the bottom 250 stocks in the S&P 500 in terms of aggregate market cap, and that's a staggering number. Very different from the 99, 2000, where it was much more fragmented. You had a lot of these IPOs that were trading on multiples of clicks or revenue or whatever. You just don't have that sort of environment right now. But what you do have is 5 companies that are dominating, not especially expensive in terms of valuation, but their profitability has to be sustainable to sustain the market. And I think that's just a critical question all investors are having to ask. Right now, it looks really good, and the question is, can they sustain it?
There seems to be a pretty big gap between those 5 companies and the rest of technology, you know, the old tech, the old guard tech companies, which are trying to get into their own version of big data and machine learning as well. Can they catch up?
Microsoft did it.
Yeah.
They're not there.
But IBM has been really, really trying.
Yeah, I was going to say IBM's a good example.
But they have not been able to grow revenues, and profitability is under pressure. I think it's very, very hard.
I'll tell you
Maybe
can
someone-
I tell you a
go ahead.
great story about Watson?
Please.
So I actually said to IBM, okay, prove to me that Watson works. So I gave it everything that the bank group has ever done in Indonesia. And we had just finished constructing a very large underground and overground subway in Jakarta. So I said, okay, show me where the subway is. And do you know what Watson gave me? All of the Subway restaurants. So anybody wants to buy a sub sandwich, I now know where they are in Jakarta. And I'm like, huh, I gave you a lot of information and you didn't find one thing that I was looking for. So, you know, there's hiccups. It's good for certain sectors and certain industries when the questions are yes and no, like medical, right? But when you're asking open-ended questions, we still have a long way to go.
Would Siri have gotten that question right?
What about
Siri would
Ken
not have
Jennings?
gotten
That's
that
who I
right.
think from Jeopardy.
But you know, try Google Translate, and if you fiddled around with it 2 or 3 years ago, it was really hard to use, buggy, almost wasn't worth the time. All of a sudden, you've just seen this inflection point, and the utilization of Google Translate has gone through the roof, and we've seen that in a lot of these AI-driven technologies. So I do think that, yes, you still get a lot of those experiences, but it's changing really,
So the
really
neural
fast.
networks are really helping. too.
Yeah,
I mean,
they are.
You know, I wonder before we tack away from big data whether you know, we talked with Bill about omni-channel, and,
Yeah.
and
Yes.
you hadn't touched on it, and I think it's
Okay.
there's
Actually,
a lot
it's
of people
perfect
sort
timing.
of thinking about this, because one of the things in particular with retail is it certainly feels like when we read about that it's at a tipping point, and I think with the cars and oil and whatever, it always comes down to what the tipping point is. At some point, everyone sort of freaks out and kind of panics about it, and this is one where big data has been long involved. And now we really are, it looks like we're kind of changing the model, and it has a lot of, you know, roll-on effects to a whole bunch of other sectors. But,
Yeah, I spent a lot of time in malls, and I spent a lot of time in San Francisco high-end stores. And the problem right now is that these stores don't have any customers. And so they might have people coming in who are visiting San Francisco and they'll walk through the store. But in terms of purchases, you know, we do a lot of diligence in going to all these stores in the best part of San Francisco, and they just don't have customers. And there was actually a panel about an hour before we got in here talking about big department stores and malls. And we did a conference 2 weeks ago down in Santa Monica where we talked about omni-commerce companies. And so omni-commerce companies are things like Thrive Market, which does something online. You can go there and get them online. You can get them on land. Or Bonobos, the pants I'm wearing right now. You can go and get a style fitted to this and then have the Bonobos shipped to your house. If you're depending as a retailer on someone walking into your store to buy something, you're in a pretty bad space right now, because almost everybody has to transition to omnichannel. You have to be able to buy it online, you have to be able to buy it at the store, and you have to be able to combine it and get the proper service. So, you know, Casper, I don't know if any of you have gotten a mattress from Casper, but I have a mattress from Casper.
Oh, they advertise in the subways and everything.
So they shot over to my house, I opened the box, flip, there's a mattress, opened it right up in my bedroom, it was fine. You know, Books, which is a online flower company, and you know, many of you didn't know this, you may have thought about it when you received flowers, but flowers come from 2 Latin American countries, Ecuador and, anyway. So it took 9 to 10 days to get to the consumer in San Francisco. And they've broken the channel, they've taken planes right into Ecuador, they skip going to Miami, which they used to do, and have 3 days in Miami, and they get it out to all the states 3 or 4 days earlier than they otherwise would have. And then Stance, which is a sock company, which I'm not wearing the Stance socks, but has another, you know, have great colors, and if you go around Silicon Valley now, no one wears socks anymore like this, they wear colorful socks. And also you have the way things are sent to you. So Stitch Fix will send you a box of clothes. You try on the clothes for a week. The clothes you like, you keep. You pay for it. The clothes you don't like, you send back. Honest Company will send you stuff like that. You can decide what you want to keep. And so there's a lot of predictive modeling that goes in with these companies. And as a consumer, my team basically has a membership or a subscription to all of these, and we can see who does the best, access to products and how quickly it gets to you, what their follow-up is, what the health of their products are. So this is something where I usually don't walk through malls, but I went over to 3rd Street Promenade in Santa Monica, and stores were pretty light. People were walking along the promenade. Then I went to a very beautiful new mall, which was right next to a shuttered Sears, right? And there was no activity. And so unless you can connect with your customer somewhere else than have them walking through your store or walking through a mall, you're in big trouble today. And so that's probably, in terms of how much time we spend with customers, it's probably the highest portion of our due diligence we're doing right now.
Alex?
And the thing I would say about this is what's always great as an investor is when you get to these tipping points, you also frequently will have sort of massive gyrations in what the valuations of these companies are, and there is no better opportunity to invest when you have massive gyrations. When people throw the baby out with the bathwater, as we often say, you'll have big, huge swings, and those are the places you really can do significantly better than the general market. And so I would say that it has both the positive and the negative. You can negative read through all the way down to warehouses and what's going to happen to Macy's or whatever, but someone's going to chuck that completely out the door in terms of a pricing standpoint, and there's probably an opportunity at some point where it's massively
and Jeff Bezos has done that.
So, and I would say the key thing to do is just look at same-store sales, and if a company is still growing in this environment, a retailer, ask why and is it sustainable. Home Depot and Lowe's are two great examples. I would argue that I'm probably going to go to Home Depot or Lowe's for a lot of large ticket items, and you can get it all done at once. It's pretty inefficient for me to go in and order everything from Amazon Prime, even though I'm a big fan of Amazon Prime. So that's one area where they've been able to defy that trend. Now, I think we have to watch it carefully because Amazon's smart and they'll figure it out over time, but you can find those survivors.
And you also get, one last thing on
Sure.
this. You also get an M&A activity pickup when this happens. So if you look at PetSmart acquired Chewy, probably not many of you have heard of Chewy, but it was a pet food company down in Florida, and they just bought them for $1 billion. And Unilever bought Dollar Shave Club, which is all it does is ship you little razors that you can put in your razor. And Honest Company and Casper and some others, there's been rumors about people look at them, possibly buy them. So you have a whole bunch of things you can do here. You can finance them, you can invest in them, you can help them be merged into bigger companies or purchased. So this is the phase where in omni-commerce where we're seeing everyone looking around. So we have meetings with the largest retailers, we have meetings with the smallest retailers, and we have a very big Venn diagram of who should be talking to who, and we talk about it every day. That's sort of, rather than the sports section, we look at that Venn diagram.
Alex, how does this all show up in the research that you do?
We've been asking ourselves for a while, again, does it all go in one direction? And I particularly look at the UK versus the US market. We're quite big in the UK on online grocery shopping. And I keep being told it's just not going to work in the US. And the reason is the distribution of people. So you've got a number of large centres and distribution routes work there. But if you're
in
out
cities,
in the
urban
middle,
centres.
if you're out in the middle of nowhere, you need people to come to you because you just can't make the economics work. So again, some places it's going to work pretty well. Some places it's going to be prohibitive. Retail is one of the sectors under the most pressure. It's leading our high yield default forecast this year.
Our macro
So
team
I
did
actually
an. Oh, sorry.
think
Go
3D
ahead.
printing plays a role in this,
Yeah.
right?
In retail?
Absolutely.
Yeah. Oh, yeah.
So
Yep.
you're gonna be able to go in. Well, and Under Armour's already playing with this, right? How do they 3D print your shoes? You can go in, they'll measure your foot. They'll get it will be printed to meet your foot. You'll have a running suit, and all of their fabrics are synthetic, so they can be created in a 3D printer, and it'll match your body size, your lengthwise, and it'll be printed in 15 or 20 minutes.
But does that though just get you to the store? Because I think we've all
Yeah, that's why
probably
I'm
been
not
to
sure
these
storefronts are going away. I mean,
because
I think
you're
you'll go
gonna
for something else.
It's going to be
yeah.
an experience. It's going to be they're going to watch you running. They're going to measure you.
Yeah.
But think
you're going to
about
have
the
your
supply
beautiful
chain,
customized Under
like
Armour.
for someone, like if we took AutoZone, O'Reilly, and Advanced Auto Parts, and you think about,
Yeah.
we all drive these random automobiles, and the
Yeah.
customer drives them in and asks for, I want a 72 Buick LeSabre piece or something, or there may not be a 72 Buick LeSabre.
And they'll print it for you.
And they'll print it for
Yeah.
you. And
This
then you
is-
don't
this is
have to
exactly
store
right.
it, you don't have to warehouse it, and you don't have,
Yeah.
as long as you have the file that has it and the right powder, you could go.
And
you
so
could
we
go and
invest
make
in
that
a lot
base.
of those automotive
Yeah.
parts companies in emerging markets.
Yeah.
So what's going to happen to them?
Right.
They're not going to be around that much longer.
Right, but you still need the storefront in
You
that
need the
instance. I
storefront.
mean, it's a bit like, I mean, we need Home Depot because we can't have drones drop off 2x4s. But I mean, at some point,
At some point, that might just happen.
Okay,
Yeah.
but this is interesting. I don't know if you guys saw Jim this afternoon, our president who talked at lunch, but we've actually been working with a drone company in Rwanda.
Really?
They come out of the valley. I met them, and I thought they were
yes,
the coolest
yes,
guys on earth.
yeah.
So they have a pod in the middle of Rwanda. They have complete control of the drug supply and the blood supply, and they can service any of the hospitals and clinics. And so the doctor calls and says, I need O negative blood, and poof, drone flies it out and flies it back. So it's possible, and we've worked really closely with the FAA in Rwanda.
Is that something that's replicable in the United States or a developed
So now
market?
Kenya and Tanzania are next. So Africa's a little easier from a regulatory perspective, but we'll see.
Perhaps one day. Chris, when you look at retail and you look at a company like Sears, and we talked about department stores and how you mentioned it was empty, you painted this grim picture here. Can a company like Sears use technology to get out of the fix that it's in, the bind that it's in?
It's hard. We did actually an analysis internally of retailers who make announcements around downsizing, closing stores. A lot of them are doing it. Macy's is one that I think, to their credit, they are being really proactive and trying to get ahead of this trend and really focus on their most efficient properties. But the study showed there are very, very few instances where a company has been able to cut the number, their size footprint, and actually then start growing again and outperform on the equity side. And I think on the debt side, similar thing. The spreads are definitely wide in retail. Investors have realized that there are problems there, and so you're going to have to be paid more to hold the debt. But we've seen nothing but those spreads continue to widen, and then you start to worry about liquidity concerns and the ability to maintain investment grade status, and it just really becomes a tough spiral. So I think it's going to be tough.
That's one thing. So one of the things I think you should watch is, Walmart bought Jet to compete with Amazon. And obviously Jet's a lot smaller than Amazon, but it's got some great engineers and really smart people. So it's going to be interesting to see if that works and you see Walmart get a lot of momentum online. Does Amazon go and start opening stores? And so that's going to be the trick. They've tested some up in Seattle, and they've tested some in other cities. But if Walmart continues to do an acquisition push into retail on land and then bring these companies that are online,
Amazon's response
Amazon
is-
might do the same thing.
Right.
So,
Why don't we talk about rockets? Let's go from retail to rockets, something far off in the distance, perhaps, or maybe not. Chris, you guys own SpaceX, right?
We don't own it, but we did make an investment there.
Okay.
And it's with some of the large mutual funds, and I would say it's a relatively small investment. But we had a relationship with Elon through Tesla and SolarCity. And it's a very different type of investment, I think, than your typical, even a private investment. He's on the record for saying, well, we might go public in 10 years or if we get to Mars. So that really forces you to take a long time horizon with it. But I will say, in the last 3 months, I think he has successfully landed 10 reusable rockets, and maybe 8 or 9, sorry, 8 to 10, but just had one today, had one about a week and a half ago. So you're really seeing success there with a commercializable technology that it's going to be what pays the bills for his broader aspirations, and it's really exciting. And so they've got a cost advantage versus all the other major satellite rocket launchers that it's going to be tough for others to catch up. And there's a lot of money being spent in the space, so SpaceX is not the only game in town, but they're so far the only one who's been able to do it and do it repeatedly.
Where are the investment opportunities in rockets and robots, Alex?
We have no official view on rockets.
I would say this: there's a 2-hour video from a code conference about a year and a half ago where both Jeff Bezos and Elon Musk gave about an hour interview each. If you can watch that interview, It's remarkable on all the things we've talked about today.
So give us the one piece of news that you learned from that.
That really smart guys always look up to space. No, they're just. I mean, I've known them both for a long time, just because I've been in the Valley a long time, and I took Jeff public way back when. They have no fear, and Elon's gone through a lot more ups and downs financially than Jeff has. But Jeff has plowed ahead in a really, really tough business. To do what he's done in retail, just starting, as a little website. When we took him public, he had $16 million in his previous quarter. So it was a tiny little business. And it was a $480 million market cap, I think. So I would never bet against either of those two.
All right, and on that note, we're going to open the panel up to questions from the audience. If you would like to raise your hand, and we can bring a microphone to you, let us know who you're directing the question to, or whether it's to all the panelists.
Hi, my name is Elsie. I'm curious for everybody, what technology trend would you like to most invest in?
Who wants to take it first? Nat, I'm going to call
Sure.
on you.
I'll do. I'm definitely a believer that autonomous cars will take place. I think a lot of people ultimately want them. I think the struggle, which we've kind of talked about, most of them are out there. I think range is still a problem with EV, which we didn't sort of touch on as this issue, is what do you do kind of in the middle of the country, and how do you deal with it if you drive it more than, we'll insert a mile limit where we may be right now at 200 to 300 miles. But I do think it's something that everyone, kind of particularly likes, at least for one of their automobiles or their sort of like, their commuter vehicle. And I think it's something that you could actually get more miles driven than we currently have now. And the reason why that is that if I said to you there's sort of instead of taking a short haul flight from, I don't know where you particularly live, but insert your town here, Boston to New York for me, right? It's a pain to go through TSA, it's a pain to do the Amtrak, the country doesn't really have a great train system. I've just created for you your own personal subway system. And I think that you will see sort of more miles, and then as you drive the cost down, as you get to this tipping point, I think it's a sort of a fascinating opportunity as well to sort of, kind of democratize travel like a little bit. In my space in particular, the large tech companies that are out there, they're very, very high quality, meaning that they have a lot of money and they have a lot of resources that are out there. I think that they will certainly chase it, but in terms of they're also very rich right now, and so I'm not sort of pinpointing that as like this great sort of investment opportunity. I would more likely kind of chase after that kind of in the equity space, but that's sort of the one that I really feel like that's going to nail it.
Well, speaking of the equity space.
Well, I would say artificial intelligence, and that's cheating a bit because it touches so many different companies, so I get a lot of shots on goal. But I also think that those companies that are in the forefront of AI, and Amazon, you could say, is very expensive right now, certainly on current earnings, the way they're running their business. But the others, you're not having to pay these $19.99 type multiples for some of these most innovative companies. And I look at if you tried Siri 3 years ago or 4 years ago, chances are you were kind of bored with it or frustrated. And for me, I didn't even come back to try it for a couple of years. But like, you try it now, and it's totally different. It's so much better, and Alexa and all these different technologies. Yeah. And I just think about 5 years from now and what they're going to be able to do. I think it's really exciting. Those companies have such great growth engines in so many other areas too. It's a good place to bet.
Alex?
I work for a rating agency, so can't invest in anything. But in terms of what I think might change my life most, I think it's the autonomous cars, actually. So we're not looking at cars being disintermediated. We're looking at transport being changed completely. So at the moment, I drive 10 minutes to a train station, get a train, get an underground train. I need my car to be there. It needs to be my car to get me to the train station. If it was call up something and it turns up at my house and takes me straight to work and I can do whatever I want, now that starts to sound really interesting, really life-changing.
Stephanie?
Okay, so I have to get 3 kids through college soon. So I'm not going to take any wild bets. I'm going with digital infrastructure. And I would do digital infrastructure in the developed world and in the developing world. And I mean, in the developing world, we've already proved that it's profitable, but in Africa, there's somewhere between 15 to 18 billion dollars of fiber that needs to get laid just to get to where China is today. So I think there's huge opportunities in the digital infrastructure space.
I'd say I would invest in Airbnb when you have a chance.
You're looking at your client list. And
It's not my client list. I have a very high level of respect for them. I think they're incredible people. I think they've built a really great business. So I think of all the big unicorns, that would be my favorite. I think on the public side, Netflix as a addition to what
Even now at these valuations.
Yeah, we talked about that. I mean, Reed is brilliant. I mean, Reed started in 10, 15 years ago. You would go to a store and have it delivered to your house. And I actually told him I didn't think it was going to work, and so I did not participate in that IPO, which was probably the saddest day of my life. And I think in real estate I would go Zillow, and then the hope I have someday is that someone comes up with a great education company, and it can help the masses. So I don't know which one it's going to be at this point, but.
That still hasn't happened. All right, last question to this lady who's standing up. Oh. And apologies that this will be the last question because we actually are running low on time.
Serena Rosso from Australia. I'm involved in education, training and jobs.
Oh.
So I'm fascinated about trends in education. And you said you'd like to see what sort of model, particularly in higher education. We dream about going to Harvard and all these other major universities. What do you believe are the trends that are actually happening now that we're confronted with also, students. Students no longer want to learn in a conventional environment. So I'd be fascinated by your way of interpretation because, we've invested millions in Australia on education.
Yeah.
Thank you.
They want an experience.
Coursera was a company which was one of the earlier players in this, and I think 10 years ago everyone thought it was going to be the leader, and they do a lot of things at Stanford. But the reason I brought up education as a category and not as a company, I just don't think we found it yet. And
so what do you think it is?
well, if I knew what it was, I'd say I found it. But well, I don't know. You might.
Well, I mean, I'll take a stab. We look a lot at education, and I think one of the things that we're beginning to believe is that education, as we know it, especially at the higher education, is going to go away. And what you're actually going to have is a much longer, much more episodic learning process that allows you to pivot your career as you move. So you might take the equivalent of an associate's degree online, and then you would get a job. And while you're in that job, you realize, okay, I want to go this way. And then you would finish and have the equivalent of an undergrad. And you'll take most of those online, and they'll be offered by any of the major universities. So you're already seeing MIT and some of these guys play in this space, and I think they will continue to. And universities, at least in the United States, because they are so costly, as we know them, will slowly dissipate.
We just saw Purdue University bought Kaplan, which is fascinating. I mean, just a kind of not a Hail Mary pass because it's Purdue, but they I mean, it's a real school, but they basically saw the writing on the wall and said, we need to have an internet offering. There's a school right in our backyard, Southern New Hampshire University. I'm sure you've all heard of it. They have about 15,000 students. They have 80,000 online students. 80,000. I mean, this is a tiny little campus in Manchester, New Hampshire. And they were one of the early adopters of an online strategy. So I think universities can make it work. The question is just how many players are there going to be, and what does that business model look like?
Yeah, and this is also really where kind of we get back to this big data and AI ideas. This is this radical customization of the education process out there. And there are folks who are kind of looking at it, but taking like a Southern New Hampshire university and customizing it so the student is good at this, and then or they're bad at this, and then a tutor sort of comes in online, and all that stuff can really tailor it so that, again, your online experience is as good as though you were there in a small size classroom with a professor who noticed that you were not proceeding along as quickly as you should and reaches in and kind of helps. So it can happen.
All right, and with that, I want to thank our panelists for this afternoon's session. Thank you for attending.